Okay, before we're going to do a couple of questions and take a look at a few issues before we move on to the second module. And as I said earlier, and as I mentioned to a lot of you, I want to try to, we'll take our time, make sure everyone's got a good grasp on the material before we move ahead. And this morning, the first thing I'd like to do is I'm going to go back over this illustration just briefly. I think we spent some time on it, but I just wanted to be sure we go back to this first module. Understanding its purpose was to create a background with not only definitions but with theory, so that you understand clearly that we're looking at contracts, lease contracts that do not provide legal title. However, in substance, economically, they are equivalent to a purchase of a long-term asset using debt financing. And the issue is whether or not that transaction should be reflected on the financial statement. So is it an equivalent of a purchase of an asset using debt financing? Does economic substance take preference over legal form? And to operationalize that, we came up with the criteria for capitalization. Under US GAAP, we had the four conditions, which were, of course, transfer of ownership, purchase option, bargain purchase option, 75%, 90% tests. 75 and 90% tests were a little bit tricky because they're not always as clear, but in all cases, the issue is whether or not the lease transfers risks and rewards of ownership to the lessee. If that is concluded, you have a capital lease. If you don't meet any of those conditions, you have an operating lease. And when you have a simple operating lease, if you remember, you had lease payments of $1,000 a year for X number of years, whatever it was. But when it's an operating lease, you debit rent expense, credit cash, and that is it. The primary issue is that by using the operating method, it keeps the asset off the books, it keeps the debt off the books of the lessee. Now, after a few minutes today, we're going to be spending lots of time on the mechanics, but I think to really understand the issues, we have to think about the financial statement implications. And the financial statement implications are serious enough where the new standard, if it is passed, will capitalize all leases with terms greater than 1 year. So that this is a problem where you get an airline that has 300 jets and 230 of them don't show up on the balance sheet. It's insane when you think about the fact that, Continental Airlines could be operating where the majority of their equipment is not on their balance sheet. The majority of their debt does not show up on their balance sheet. Now, again, do we have enough disclosure? Absolutely. And financial analysts can handle this, but the idea is to make sure it's transparent to the average reader of the financial statement. So back on page 12, if this was an operating lease in module 1, you've got a debit to rent expense and a credit to cash, and that's it. The disclosures, yes, we'll talk about them, do indicate the commitment to make those payments on these leases, but in fact, it would not be reflected on the balance sheet. Now, on the other side of this, if any one of those four conditions happen to be met, then you would have a capital lease. So let's say that, and I'll try to review some of the nuances. If the fair value of the asset or the present value of the minimum lease payments, the lower of the two is $6,500, that becomes for the lessee the leased asset and the lease liability, the obligations under capital lease. So when you have a capital lease, the problem is that the lessee is required to have the asset and the obligation on their books. And we said that cosmetically, the problems are one of eroded financial ratios and lower net income. So, and I'll show you that in a moment again, but you have the debt equity ratio clearly at a disadvantage if you capitalize. Then, of course, if it's an annuity in advance, the payments are up front. And I did have a question after class that I want to address right now. What you have to remember is if you look at the lease structure, we're going to go over this again, but if the liability is $6,500 and that's at time period 0. When you have an annuity in advance, this is something that some of you may have worked with, but we're always used to annuities in arrears or ordinary annuities where everything's done at the end of the year. Here's what happens when you have an annuity in advance. The payment comes off at the beginning. So that out of that $6,500, the cash payment reduces the liability, so only $5,500 is subject to interest. And in this problem, we had 11.2% as our interest rate. So the interest that accrues is 616. Now, at the end of the class, someone asked a question. I put some dates in here, so that may help you as well. So that if I'm reporting at December 31st of 2014, it means that I would have to show interest accrued at the end of that period. So I sign the lease, I put the liability and the asset on the books. I make my first payment. Then the interest on the top of page 13. The interest is $6,500 minus the 1,000 times the 11.2. That's the 616. So the 616 is the interest for that period. Now, what I also mentioned is that it's almost simultaneous in here, obviously, but on January 1 of 2015, when I pay $1,000, I'm going to be paying off 616 of interest and principal of how much? 384, the difference. So, although I'll show you the payment entries as we get deeper into this, but the payment of 1,000 has principal and interest. So when you report back on December 31st, you have to understand that the current portion of long-term debt is 384 when you report at 12/31. And of course, the depreciation or amortization is just straightforward. You just have amortization expense and accumulated amortization. So if you have a capital lease, it mimics a purchase. It's exactly like buying the asset. The only problem here is that unlike Chapter 14, where you had annuities in arrears or ordinary annuities where the flow seemed more logical, when you have a lease, the payments are upfront and it reduces the amount subject to interest. The accrued interest is only going to be based off of the liability minus the payment. Payments are always upfront. And we'll do a lot more of this later, but I just wanted to clear this up so that when you get to the balance sheet, you see that for an operating lease, the only effect is the cash outflow of 1,000 and the rent expense that's closed to retained earnings. But if it's a capital lease, you have $1,000 cash outflow. You also have the leased asset minus the accumulated amortization or depreciation. And then up in the current liability section, you have the amounts that are due in the next period. So let's make sure, especially from the standpoint of thinking back to accounting, principles or accounting for managers or even your auditing, we have the cutoff in the time period. So in 2014, you had to accrue interest of 616, but in 2015, at the beginning of the year, you make the payment. So if this balance sheet is as of 12/31/14, I'd have to show the accrued interest and the payment of the principal. And that's how I get the 384. So when I pay the $1,000 goes against the principal plus the interest. And when we build larger amortization tables, you'll see this over and over again. So this is a fundamental principle that you have to keep in mind, that every payment gets split between principal and interest. And then, of course, the long-term obligation is 65 minus the 1,000, and this is a simple, the 384 is a reclassification. You take it out of long-term debt and you call it current. And we did that back last semester, I think chapter 5, when we covered the balance sheet. Right? We showed you that debt that is payable in installments, you'd have to take the current portion out of the long-term debt and place it into current liabilities. And of course, this is some of the arguments that I was making why lessees do not prefer a capital lease. The capital lease will erode working capital with these current liabilities, also puts the long-term debt on their books, and it lowers net income. Because if you look at the retained earnings, that's coming from the income statement, which I'll bring up on the screen in just a second. So again, the capital lease has those cosmetic accounting disadvantages. So hopefully that, I know I had the question, I know I answered it on a one-on-one basis. If you had the same question or issue regarding the timing, and we're going to go over this again today, but the payment comes off first, and then the interest is accrued. And then, of course, down on the balance sheet, income statement rather, you have a higher net income under the operating method. Now, higher net income is not the only measure we use. If we're looking at, I think I did this also, but let me make sure. It may be more important to look at earnings before interest and taxes, earnings before interest, taxes, depreciation, and amortization. So if I'm looking at EBIT, earnings before interest and taxes, I'm taking a $1,000 hit if it's an operating lease. If it's a capital lease, how much are earnings before interest and taxes affected by a capital lease? Only what? By $650. Right? Because the interest would be ignored in this measure. So capital lease shows higher EBIT. And if I'm using EBITDA, I would not have the depreciation either. And operating lease shows 1,000, capital lease, no expenses. So that I get higher EBIT, higher EBITDA with a capital lease. Now, that's only one of the favorable sides of it. I mean, I think if you look at this from a lessee's perspective, they are really trying to avoid the debt more than anything else. So it's really to avoid the debt. But under the new standards, if everything gets capitalized, one of the things I'm reading in financial analyst journals and Wall Street Journal or other business periodicals is that they're saying that you could expect an increase in EBIT and EBITDA from the new standard because everything's going to get capitalized, so that you'd be able to keep the rent expense off the books and only show interest and depreciation, which, although lowers net income, the primary measure in lots of ratios is going to be the EBIT and the EBITDA. Okay. All right. And finally, the last thing we did was cash flow. And again, there could be a slight advantage here for our friends with the capital lease because operating cash flows are higher. Because with rent expense, it flows right through net income, reduces operating cash flow. Capital lease, what happens? Net income is reduced by depreciation and interest expense. Interest payable is a current liability. Increases in current liabilities represent obligations that were unpaid, added back in operating activities, and of course depreciation's an add back as well, so that you have no effect on operating cash flow. So you are doing better with a capital lease here as well. And of course the payments are classified as financing. The payments are classified as financing outflows. Okay. So to summarize then, if you look at capital versus operating leases, and I know we went through lots of definitions, but just the broad picture that we need to step away with, or the takeaway, is that when we look at capital versus operating, which makes this controversial, and this discussion won't exist maybe next year or a couple of years from now if they pass the new standard, where the balance sheet will not be affected, income statement may be slightly different, but the rules will be much more, I think, reasonable, more simplified, and all leases will be capitalized. So this will not be an issue. But right now, does anyone have any questions regarding the preference for operating leases by the lessee? You'd really need to be able to explain, and that, I think it's one of the essays for homework anyway, but I don't think I'm going to, if it's there, it's not going to be on an exam. So on one of the essays for homework, it's asking you the preference and why it's preferred. So it's clearly to keep the debt off the books, higher net income, higher ratios in terms of debt equity is, well, I should say, improved by an operating lease. Return on total assets using net income is improved, and net income, of course, is higher. So the lessee has a preference for an operating lease. Okay. All right, so that's where we ended on Tuesday. Does anyone have any questions on this at all? Okay. We will obviously start digging into more of the debits and credits, the more accounting, the less of the finance end of it. But any questions so far? Okay. All right, now I'm going to ask you some questions, and again, oh yeah, you have one. Good, good. Yes. Yes.
Yes, why is the current portion of this debit current liability? Why do you put it?
Because it's due, what happens is that on December 31st of 2014, I have to show the reader the financial statements, all of the obligations that will use up current assets. And the $1,000 payment will use up cash in the next accounting period. Therefore, it has to be classified as current. Now, if you remember from Intermediate 1, when we talked in Chapter 5 about matching maturities, what we like to do is be sure that current assets are matched with current liabilities on the balance sheet, so that I need to know what resources are going to be used to pay off obligations that are due in that period. And that's why we do it. That's why we make the classification. Now, for me, if you put the current portion of lease debt as 1,000, it's okay. You know, to me, the breakout, it's important for some, but for me it's not as critical because it's going to be going against the same debt anyway. And usually the interest accrual gets added on to the lease debt. But for disclosure purposes, this is more transparent.
How about you get with current portion of this debit out of current liability, and also in the long-term debit, you don't minus 300.
Yes, right, because the lease debt itself is going to be higher if I don't take this out. And I have to separate out the current from the long-term portion. If you remember last semester, we said, what if you had a long-term debt with a face value of $10,000 and $1,000 is paid every year? How much is current? $9,000 is current, and $1,000 is current, $9,000 is long-term. So it's the same idea. So you need to separate out the amount of the debt that's due next year and the balance, the 5,116, is not going to use up current assets. And that's why it's still long term. If I left 5,500 down here, which would be, obviously, if I didn't take this out, it would be misleading because it would appear that 5,500 is due beyond 1 year from the balance sheet date, and it's not. All right, any other questions? Okay. Yes, sure. No, because in practice what will happen is that in the amortization tables that we're going to be working with, I'm going to show you the tables, but typically in the tables we don't, when the interest accrues, we add it to the balance of the liability. Because there's going to be, for example, when the interest, in this case, when the interest accrues here, it's really being added to the total obligation that someone owes you as of that point. So some people add it right to the lease liability. You know, but for disclosure purposes, we would separate that out. You know, it's more transparent to show what's principal, what's interest. Although in the lease, since everything's being paid in that one payment, you could combine them. Yeah. Any other questions? Okay. All right. So now let's take a couple, and this way I want to make sure the clickers are working and everything else here. This first one I think is a bit more of an opinion question. So let's take this first one. I think I got this thing working. It wasn't working before. Had to reset it. So just give me a moment if it's not. What I want to know is, in your opinion, is this true or false? And of course, it has to be explained whether or not the leasing reduces the risk of obsolescence to the lessee and passes that risk of residual value to the lessor. So let's see if it's working. Yeah, there we go. Yep. Yes. Still not working, huh? You got to wake it up. Wake it up. Well, make sure you're on 72. Let's go for a channel. And again, there's extra credit, so it's not the end of the world. Find channels. Well, you'll get it. No, it's got to work. All right. So what do you want to do? Try one. Should work. No, try it. I'll make sure. I want to see if it. Did it work? Did you get anything? Hold on. What did you want to do? B, C. What'd you say? I don't know. I'll give you whatever you want. B? How come it's not working? You're on 72. Maybe I'll give you another one. All right, hold on. Maybe I'll have to give you another one. Okay. I'm going to have to get you in. Yeah, we got to fix that. Okay. All right. Let's move that over. Okay. So, yeah, I mean, it's pretty much, I'm not going to grade this. I guess you could say it is correct, but there are some arguments against it. I mean, you could argue that the lease actually, in the final analysis, who's really bearing the risk of loss? It's got to be the lessor. I mean, even though there's the residual value, it could be worse. I mean, what would happen if it's an auto lease and you happen to be leasing a huge truck that gets like 6 miles to a gallon? You give it back to the dealer, the car is in perfect shape, thinks that's the fair value, gas prices go up, and the truck is literally discounted, you know, almost in half. So that risk, once that vehicle is turned back to the lessor, then that risk of loss is there. However, do we pass that risk over to the lessee? Yes, we do that through higher residuals, expecting more when you bring it back, or just higher rentals. So we could, in fact, have, you know, an argument both ways there. I guess theoretically, the lessee is able to escape some of the real damaging risk when the market is extremely volatile. But in general, I think what happens with a lease is that, yes, you're willing to accept, as a lessee, you're willing to accept absorbing some of that risk because of the financial flexibility, because of the business flexibility that can get you out of that contract. In 3 years, you can upgrade. There are options that you have at the end of the lease. It gives you a lot more flexibility. You've got tax benefits, so you're willing to accept those areas, or at least that risk. Okay, let's try. I'm going to do another one now. Let me move this. I'll handle that in a second. So, all right. Right now, just looking at number 2. Right now, not correct. That will be the case, perhaps. Number 3. This is a tricky question, which I wouldn't ask. It says a lease that contains a purchase option must be capitalized. That, of course, is false. It has to be a bargain purchase option. Has to be bargain, so this has to be false. Executory costs have to be excluded in the minimum lease payments. That's a simple definition. Yes?
Number 3 talks about 4 conditions for capitalization and the threshold of transfer of ownership.
The transfer of ownership has to be without payment. It just has to be at the end of the lease. You get title. It's got to be a bargain purchase option. Okay. Executory costs have to be excluded. We went through this. There's no interest, of course, in an operating lease. Interest is a component in a capital lease. Number 6. I'm not going to ask you this one, but I want to discuss it with you. And something we didn't cover, but I knew I could ask this question, or at least discuss this question with you. A land-only lease. If there's only land in the lease and you don't have a bargain purchase option, you don't have a transfer of ownership, could you capitalize it? And the answer is no. It has to be an operating lease, so that land that is evaluated and only passes 75 or 90% test has to be an operating lease. And by the way, that is true even if it's with the building. It's not only land only. This happens to be a specific question. But if you have a building with the land and it's only capitalized, or the building's only capitalized on the 75 and 90% test, the land has to be treated as an operating lease. Why? Well, just think about the test. The 75% test and the 90% tests are not operable with land. Why? Well, if you take the lease term and you divide it by the economic life of land is what? It's like approaching its infinite. So obviously this is going to go to 0, and you're never going to get anywhere near 75%. So that knocks that out. And if you look at the 90% test, the present value of the minimum lease payments over the fair value of the asset. I mean, in this case, what will happen is that obviously even if the lease is 10 years, when is the residual value? The residual value would be what? How could you actually operationalize that? You can't, because the land could last for 80 years, 100 years, and values could go higher and higher, so it doesn't make any sense. You can't really operationalize that. So you can't operationalize the 90% or the 75% test when there's land. Yep. Yeah, and that's the same with, you're right. I mean, it's the same question that you have with depreciation and depletion. So, for instance, land that has a value because of mineral deposits would be eroded, would be depleted, and could be negative scrap value as well, right? If there's cleanup and things like that, right? I mean, obviously that would not be something we'd be considering here. Right? Okay. Operating lease, yeah. So land, for the most part, anytime you only have, when only 75 and 90% tests are involved, land is always an operating lease, pretty much.
Sorry, you said that the land beneath the building is always, you separate that.
Yeah. What will happen is that you would have to find a way to separate it, usually a relative fair value. So if you separate the building from the land and you only capitalized under the 75 and 90% test, the land is operating and the building's capital. It gets a little bit more complicated, but just in principle, I wanted you to know this. This is a basic idea that I think you should know. I'm not going to worry about the mechanics. All right, now let me see if I can. Okay. All right, I'll make you try this one. Yeah, try this one, and then I'll have the number, and I'll associate the number with your name, and then we can junk that one if it's not working. Okay, let's try a couple of our other questions. I think these are multiple choice, but I'm going to package them into essay questions for you. All right, so let's take a look at number 3. The amount to record as the cost of an asset under a capital lease. Okay. All right. Now again, we don't give you multiple choice questions. Just want to review some of the basics before we move ahead. All right. Everybody in? Anyone still? Everyone in? All right. Well, I'll just wait. It's 2 seconds anyway. All right. So let's see what we got. And okay, good. So everyone pretty much has it right. It is B. So let me just make sure I let you know that. So it is for item 3. Okay. So the answer is B. It means that you capitalize at the present value of the minimum lease payments or the fair value of the asset, whichever is lower. Okay, so it's B. Now, why is that? Okay, so what's the rationale? Anyone? How would you explain that if that was a true-false question? Or the fair value, yeah, the fair value. So the fair value becomes a ceiling on asset valuation. You would not be able to value the asset above its fair value. Now, here's an interesting question for you. What would you do if you took the PV of the minimum lease payments and you found out it was greater than fair value? And you capitalize fair value. Is that? No, because we're not sure of what goes in here, first of all, right? So don't forget, there's interest rates, there's other factors in here as well. And even if that is the case, the leasing terms could be, yeah, I know what you're thinking, the leasing terms could be more favorable in lots of ways than actually buying it on long-term debt. So you may still go ahead and do it. But the issue, I think, is what about the rate of return or the interest rate? Anyone have any idea? Would you have to change it or is it still valid? So if you capitalize, or I should say if you computed the present value of the minimum lease payments here under, I don't know, 10%, is now that you put this on your books as the liability, is the 10% still valid? No. So let me stretch this a little bit. Let's just take some numbers. Let's just say you had let's say you had no residual value. Future value is the residual value. 0. And you had 3 payments of 100 at 10%. Now remember, this is the beginning. You've got to get used to this again because the calculator has to be in beginning mode. So I want to do this also to remind you that if you need to switch the calculator, you have to take the blue key, hit that, and then hit the number 7. And the word begin should be on the screen, right? So the payments are at the beginning of the period. Okay. So let's say I decide to do this, and I've got n is equal to 3. I'll just put this in for you. Let me bring this down. So I want to do 3 is n, 10 is my interest rate. Did I say that? Yeah, the interest rate's 10. 100 is the payment, and the PV is 274 roughly. Let's say the fair value is 240. What's going to change in that model? What's going to change in that model? Number of periods stay the same. The payments stay the same. The present value now becomes what? 240. What happens? The interest rate is to be adjusted. So you would have to come up with a new effective yield. You would have to come up with a new effective yield. And to do that, n is 3, PV is minus 240, payment is 100, future value is 0, and you have to calculate the new interest rate. So when this happens, you have to calculate a new effective yield. You have to calculate a new effective yield. Now, what that is, I'll do it here. So just putting the numbers in. 3 is n, and I. Okay. Nope, can't be right. 240. I'm sorry. I got to clear this. 240 is PV. Payments 100. 3 is n. I don't think it could be that high. Maybe it is 27. No, it can't be that high, could it? What's that? Yeah. Mm-hmm. Yeah. But anyway, it's a new. That would be. I guess that's the new yield here. It's kind of high, but that would be the new yield. So you'd have to calculate a new effective yield. I didn't think it would be that high, but I guess just throwing some numbers around sometimes it doesn't always work. All right. Yep. So it's still beginning mode. Right. All right. So if the present value of the minimum lease payments is higher than the fair value, you have to calculate the new effective yield that would equate the payments with that value at time period 0. Okay. All right. So any questions on number 3 or any additional questions? So that's the asset side. And of course, let's do the liability side now. If you go to page, or the next page, or number 8. All right, so we take question 8. In computing the present value of the minimum lease payments, the lessee should use, we want to know what rate to use, what interest rate. Okay. There's so many people are here. Okay, let's see what happens. All right, so it is the answer is C. So you have to use the incremental borrowing rate or the implicit rate if it's known, and the lower of the two. So you always use the lower of the two. If this is IFRS, it's always the implicit rate if you know it, regardless of its magnitude relative to the incremental borrowing rate. But on the US GAAP, you've got to use the lower of the two. Now, of course, that answer, C, is insufficient. Why? Why do we use the lower of the two rates? What would be your explanation? So if I ask that question, I could just take, for example, and I think this one is another one of the assignments. I think it's an assignment question. Either one is. I forget which one. But let's go back to the question. If I treated item C as a statement and I wanted you to explain it as either true or false, what's the rationale? Yes, Alan? Right, so if you use the higher rate, it understates the lease liability. So we want to use the lower rate to avoid and this all comes from the fact that you expect the lessee to prefer an operating lease. So you're trying to stop them from manipulating the lease liability. And also, avoid possible failure or purposeful manipulative failure of the 90% test. So, for example, if I use a higher rate, oops, let me move that over a little bit and correct it. The higher rate will result in a lower PV of the minimum lease payments and, of course, could lower the ratio. And you could fail the 90% test. So it could be that if I let the lessee pick or select the higher rate, it would in fact result in a failure of the 90% test and avoid capitalization. And that's why it's there. Now, of course, if we go to 100% capitalization, this kind of gaming will be minimized. We'll put at least some of this to rest and avoid having this these checkpoints. The new lease standard will probably look like IFRS, and you always use the implicit rate unless you don't know it. So that would mean you'd get a lot more accounting symmetry, which we'll talk about. All right, so does anyone have any questions now on, I guess, the preliminaries? I know we're spending, as I said, I promised you I'd spend a lot of time on everything, and I will. So any other questions with the preliminaries on leasing? Okay. All right, now the next module is where we're going to start looking at some examples, and we're also going to get into the lessor criteria. Now, you have to remember, and let me bring this up on the screen for you. You have to remember the lessor, and these are our objectives for this module. The lessor has a separate set of criteria from the lessee, and that's only under US GAAP. Under IFRS, the rules are the same, so that there are no differences between lessor and lessee accounting under international standards. Under US GAAP, we have a separate set of criteria. Now, they're not that divergent. I mean, back in, even before I started studying accounting, we had divergent rules. They were totally different accounting. So the lessor and the lessee were subject to rules that were completely different. Here, there's some similarity. Then I'm going to show you the US GAAP rules-based standards against the IFRS principles as applied to lease accounting to show you that under US GAAP, it's easier to manipulate the rules and get what each party to the lease contract wants. I've already said that the lessee wants operating lease. Lessor would prefer a capital lease. And how do you do that with the same contract? And I'll explain that. And then we'll start illustrations without residual values. And we'll get through a lot of illustrations today and pick the rest up on Tuesday. Now, with respect to the lessor, of course, the lessor could have an operating or a capital lease. And when you do have a capital lease, I need to explain that when the lessor has a capital or a finance lease, there could be two types. You have either a direct finance or a sales type lease. Now, a direct finance lease is going to be very common when the lease originates with a financial service entity. Banks, insurance companies, investment banks. Only interest revenue is earned. There's no markup. So, if you think about it, a commercial bank buys an asset at selling price, at fair value. So, Prudential buys a jet from Boeing, they pay market price. They don't mark it up. They don't have a gross profit on that. So the only return to the lessor is interest revenue. Now, on a sales type lease, we have dealers and manufacturers that would use this type of accounting. And here, not only do you have interest revenue, but we have gross profit. So we have gross profit. And the gross profit is, of course, selling price, I'll be out of the way in a second, or fair value, minus the cost. And that is known as dealer or manufacturer's profit. That is known as you can see on the screen, it's known as dealer or manufacturer's profit. Okay, just the terminology we use for the gross profit is called the dealer or manufacturer's profit. So in the first case, in a direct finance lease, I mean, you're just simply providing financing for the lessor, or lessee rather. And that's it. It's a source of financing. Here, it's financing plus the sale. So you're using this as a way to market your product, and plus you're providing financing. So that the difference, direct finance lease, a bank is only interested in interest revenue. They're providing financing to the lessee. And that's it. For the sales type lease, you're looking at not only providing financing, but you're using it as a way to market your product. It's a vehicle to help you sell your product. So, manufacturers of heavy equipment, auto dealers are using a sales type lease, whereas a commercial bank, an insurance company, an investment bank would be using a direct finance lease. And in both cases, the asset is totally removed from the book. So remember, I said this on Tuesday, if the lessee has a purchase of an asset, you should have a sale. It's not always that way. We'll talk about that, but you should have a sale. So the sale means the asset is derecognized. You take the asset off the books. Whether it's inventory or whether it's a plant asset, it gets removed from the books. So the asset will be removed or derecognized from the financial statements, and the entire asset regardless of the lease term. Now, if it's an operating lease, then of course you would simply have rental revenues or rental income, and if the asset stays on your books, especially for the direct finance lease, you're going to have depreciation. I mean, if it's on your books as a plant asset, you would depreciate it. Now, we talked about the conflict of interest a few minutes ago, and we'll get back to that with respect to what type of lease is preferred by which party. We know that the operating lease is preferred by the lessee, and I'll show you why a lessor prefers a capital lease. Now, what are the conditions? I mean, how do you know whether a lessor has a capital or an operating lease? So if you go to page 2, we'll talk about the criteria. And criteria are pretty simple because we break this up into 2 groups. And as I said, what we try to do is take the concept, and we try this with the lessee, the concept of economic substance over legal form. Then we look at whether or not that economic substance exists. It exists if the risks and rewards of ownership are substantially transferred to the lessee. But now we have another problem because we have a sale. Technically, you got a sale here for both, or more importantly, you've got revenue to recognize. So the issue now becomes one of revenue recognition. So when you look at the first conditions, it says that in order to be a capital lease for the lessor, you must meet one of 4 of the lessee conditions. So now, believe it or not, this is a relatively new standard when I was in school, and it was a dramatic shift in lease accounting because now we brought harmony, or at least symmetry, to the accounting. So if you meet one of 4 of the lessee conditions, you've got a capital lease, and now you're on parity with the lessee. Now, this was done to operationalize the transfer of risk and reward. But the problem is we have another dimension for the lessor, and that second dimension is revenue recognition. What are the criteria for revenue recognition? Well, if you remember back in, I guess it was chapter 4 in Intermediate 1, and we're going to do it again in 18, and maybe even the conceptual framework, you recognize revenue when there's an exchange and the earning cycle is complete. The earning cycle is complete when there are no uncertainties as to future cost and collection. And that's all we're saying here. We've got an exchange. We assume that an exchange took place. Now we have to determine whether or not the cycle is complete. The earning cycle is completed when there are no material uncertainties as to collection and whether or not there are any unreimbursable costs in the future that are significant. If there are no significant uncertainties as to cost and collection, then it becomes a capital lease. So you meet one of 4 of the lessee conditions and both of these. Right? So the first group is for risk and reward transfer. Second group is to operationalize the cycle, the completion of the operating cycle in revenue recognition. Now, of course, there is an off chance that you don't meet revenue recognition. Then what happens? Where does the asset go? The lessee has the asset on a capital lease. You've got an operating lease as the lessor. Do you still have the asset on your books? If it's operating, well, let's say you meet group 1 but not 2. In group 1, that means that the lessee has a capital lease and they've got the asset. If you fail group 2, you have an operating lease and you have the asset on your books. So both people have the same asset. Both will have the same asset. Because if the owner of the equipment has an operating lease, they don't derecognize it. And if the lessee is a capital lease or has a capital lease, they'll put the asset on their books. So now 2 parties could have the same asset. And that's not the only time that could happen. And I'm going to get back to that because I want to ask you about how you feel about that, because we're going to get lots of accounting asymmetry in this particular standard, which may be resolved later on if the new standard is passed. May not be 100%, but it may resolve some of it. All right, now there's just one other issue before we get back to this conflict of interest and the possible asymmetry, and that is what happens with the cost or the upfront cost of the lease. Now, I know you can read this and of course you can memorize it, but you need to explain things, and let's be sure we understand what's going on here. When we look at the lessor is responsible for these upfront or initial costs. This would be handling, legal fees, contracting costs, and sales commissions. And the treatment for the initial indirect cost will be different depending on the type of lease for the lessor. Now, you can memorize this, but now you've got to explain it. So for an operating lease, all of these initial direct costs will be capitalized. You're going to set up a prepaid asset and amortize it over the lease term. Why do we do that? How would you explain that? First of all, when you look at that, if I say true or false, in your mind, the first thing you have to start thinking about is, all right, he's telling me it's an asset. Why is that an asset? What's the definition of an asset? I mean, you really have to think about sort of a box of junk, which is accounting theory, and just kind of feel around there and say, okay, I know someplace in there, I know what an asset, what's an asset? Right? But what else? But what is it? Why is it an asset to you? You can own something that may not have what? Value or benefit. It's got to have future benefit. I'm sorry? Into the payment? You could, and you do actually, and that is what is the justification to amortize it, and I'll explain that in a second. But Yeah, it's an asset because, yeah, maybe it justifies higher payments, but it also means that without the legal costs, without the sales commissions, I mean, I don't necessarily believe this. You know, I would probably expense this. But the argument is it has future economic benefit. And what I want you to think about is the way accountants think about this and the way corporations justify this. And when financial analysts look at this, I mean, you could see, remember, I don't know if you remember last semester, but I mentioned that one of the biggest problems that we have in reading financial statements are large amounts of prepaids or deferred costs. They're sitting on the balance sheet as assets. They could be disguising expenses. You know, I mean, who's to say that this should really be an asset? Nonetheless, the accounting tells us it's an asset. It's got future benefit. Without these costs, you wouldn't have the lease. Now, when we amortize it, so again, we think about this as future benefit. The future benefit is going to be the rentals. And the rentals could include, as you said, higher payments. When you amortize the expense, it matches with the rental revenue. So the idea is you defer the expense and then write it off against the revenue. And maybe, as Sally, you're implying, maybe it's a wash, right? So maybe you're getting reimbursed for it, but you're also offsetting it. But nonetheless, the idea is that you have a future benefit, it's an asset, and that asset was needed to generate the revenue, so you match it against the revenue. That's the argument. And that's why it's set up as an asset. And that's true for any of these prepaids. Any of the prepaids. Now, direct finance, that one goes right into the receivable. So that's definitely going to charge them for that. And basically, it's not a sale. So, you know, you're not really selling anything. You're just providing financing. So it's part of the cost of providing the financing that although you pay for them up front, they get reimbursed. So you basically add them to the receivable, then you get reimbursed by the lessee, and of course there's interest on that as well. And then of course here, for the sales type lease, I think it makes sense if you have a sale, you're treating this as selling expenses. So the sales revenue is going to be matched with selling expenses. And I think if you look at sales commissions, how do you treat sales commissions? You treat them like expenses anyway, right? I mean, if it's a regular sale, a sales commission is expensed immediately. It's part of selling general and administrative expenses. So it's pretty consistent. This is consistent with all other selling expenses. So it's consistent with other selling expenses. So revenue is, I should say, the selling expenses are matched with revenue. Okay, so the selling expenses will be matched with the revenue. And that's the argument there. Now, operating lease, prepaid asset. Direct finance lease, you add it as a reimbursement coming through the lease receivable. And sales type lease, you treat it as a selling expense to be matched with revenue. Okay, are there any questions on that? Again, you can memorize the table, but just make sure you've got the rationale. And these are always paid up front by the lessor. There will be obviously reimbursement in the rental payments as part of the recovery. Okay. All right, now, one last thing, and then we're going to start a series of questions. And this last point is that conflict of interest that I mentioned. So let's summarize it here. Lessee wants an operating lease. We talked about several times, and it's in the textbook and the notes, the cosmetic accounting advantages, particularly on the debt side for the lessee. The lessor will prefer a capital lease, and there's a couple of reasons for it. First of all, if you look at the sales type lease, the fact that you can recognize dealer profit right out of the box. I mean, as soon as you sign the lease, I can book sales and cost of goods sold. I accelerate revenue recognition. So I will get more revenue up front with a sales type lease than I will with an operating lease. I can accelerate revenue, and on top of that, I move inventory. Of course, I'm interested in selling inventory. I replace inventory with a more liquid receivable, correct? Because if you look at liquidity, receivables are more liquid than inventory. So I'm able to replace the inventory on my balance sheet with a liquid receivable. With a direct finance lease, it's the same issue. These are financial service companies. I think I mentioned when I did lots of consulting with the investment banks, Morgan Stanley had on their balance sheet a fleet, I think it was ocean-going vessels or a fleet of trucks or something, totally out of place on their balance sheet. They want to replace plant assets with liquid receivables, with financing receivables, much, much more consistent with their business, so that the direct finance lease would substitute the receivable for a fleet of trucks or a fleet of airlines or jets. Now, on top of that, you got your interest revenue, which is consistent with your revenue stream, which is consistent with your business cycle. And of course, on top of that, in both cases, the receivables being liquid, particularly before the 2008 financial crisis, these types of receivables were packaged in securitization deals, where I would basically sell these receivables to another entity, which was basically a spin-off or a trust within my company. And of course, the money that the entity got to buy the receivables came from debt. And they would issue debt, and the debt would be paid off with the collections of both principal and interest on the receivables. Those securitization transactions were kept off balance sheet, so that it gave the lessor another benefit by having the receivables and replacing the plant assets and immediately getting rid of the receivables and having cash. So the securitization transactions were another benefit here. Now, the question is, how do you get the conflict resolved? Well, it's not as easy under IFRS, but let's go to page 3, and under US GAAP, I'm going to give you an example, and I'm going to show you that by using rules under US GAAP, and this is some of the biggest criticism that's going to precipitate the change in standards, is that I can get the lease I want and give you the lease you want as the lessee. Here's an example. Assume that we are in negotiations for a piece of equipment with a fair value of $500. There is no residual. The lease payments are $100. For 5 years, the discount rate is 8%. Payments are due at the beginning of the year. No other conditions are met. No transfer of ownership, no bargain purchase option. 75% test is not met. Now we want to test the 90% test. So what we do is we now take the present value of the minimum lease payments, and unless I tell you otherwise, there's no executory cost. So the payments, as you know, are up front at the beginning of the period. There is no residual value, and that would be the future value here. For 5 years, this of course is your payment. And if we discount that back at 8%, the PV is 431. So if we take the present value of the minimum lease payments of 431 over the fair value of the asset, it's 86%, less than 90. It's an operating lease. It's an operating lease. Now, it means that we've got what the lessee wants. And by the way, if you don't, first of all, I think I mentioned this to you. I heard this from a CFO of a major capital company, that this happens, what I'm going to tell you happens all the time. And I know from my experience when I was doing auditing, you would go into a controller's office and we see people, or people in the leasing area playing around with computers, putting in lease terms, and it would pop up capital, operating, capital. I mean, so you really were designing leases for the financial statement implications. So we now have this lease tied up nice and neat in a bow for the lessee. Lessor, though, wants the capital lease. How do they do it? Well, here's the gimmick that has been used for years. Now the lessor buys insurance from a third party to guarantee the residual of 75. By the way, that residual could come from another entity. That guarantee could come from a related party, an off-balance sheet trust company, a related company. So that residual is now guaranteed. So what I do is I now change the parameters of the lease problem. And of course, you know what's going to happen. I'm now going to have a residual of 75. When I add that to the discounted cash flows, I get, sorry about that, I get a PV of 482. I get 96%. I meet the bright line condition, and I get a capital lease. So when you walk out of the deal, people shake hands, and everybody's got what they want. Lessee has an operating lease, lessor has got a capital lease. That means that nobody's got the asset. The asset disappeared. Nobody has the asset. You sell it as lessor, you don't buy it. You don't buy it as the lessee. I mean, it sounds odd, but it's done all the time. And not only that, you get lots of asymmetrical accounting treatment when you have different discount rates. We could also get it with residual values. You also get asymmetry when you've got, group 2 conditions that are failed, right? So lessee gets capital, lessor has operating on the group 2 conditions. No revenue rec, we said that before. Yep. Well, now it is. No, we resolve it. We're using GAAP to resolve the conflict of interest. I mean, without the what's coming up, what's coming down the pike, is there'll be no conflict, but the lessees won't be happy because everything's going to be capital. So, and there are some tweaks in here. You have to remember, this standard. I think I didn't have gray hair at the time when I started saying that they're going to change lease accounting. I mean, this has been going on for years. It's at least 10, 15 years this has been going on. They're going to change this. There's got to be some powerful lobby that's preventing this from happening. So they claim now it's going to come out this year with a 2017 effective date, but we'll see. We'll see. But this, yeah, but the use of, by the way, does a conflict of interest exist in IFRS? Does it get resolved? No, it exists all over, but does it get resolved? Under IFRS, it's got to be, what would you think? Going back to even before, even if I guarantee the residual, the lessee isn't involved with that, 86%. What would that be under IFRS? Is that substantially all of the fair value? Probably. This would have been a capital lease under IFRS. So the conflict of interest in this case can't be resolved with the standards because it's principles. The rules make it easy with the bright lines. So now, any other questions on this? I got a question for you. Just an opinion. We're going to get a lot, and it may be resolved, it may not. We're going to get a lot of asymmetric accounting treatment. Lots of asymmetric treatment, meaning that lessor has one type of lease, lessee has another type of lease. Values could be different. The asset could disappear from the economy. Both people can use the same asset. So with respect to accounting asymmetry, I just want to know. And then we'll talk about it. Do you agree? Does it bother you? Do you have any problems with it? And what would you think about if I asked you about it? So let's just see. I just want to get your opinion. Yeah. Do you think it's good, or does it bother you? Do you agree that indifferent is A too? You don't really care, and in B you think it's horrible and it's ridiculous or shouldn't be. And of course, you have to explain it to me. Got to justify your answer. Everybody in? I don't know how many people here have clickers, so yeah, I can wait. I can wait. All right, just curious. Oh, light. Somebody put C. What does C mean? C means you pressed the wrong button, right? All right. So let's see. This is split a lot more than the other class. The other class was pretty much against it a lot. So looking at B, why would you? What's wrong with it? Yep.
I just think this represents the economy as a whole. Don't have assets on the books.
Yeah, I guess if you take this from a macro standpoint, the economy is out of balance. Someone actually in the other class used the accounting equation and said, using the accounting equation on the national accounts, right, wouldn't balance, yeah.
I also think it goes against the rules of accounting itself, which is supposed to be symmetrical, which is one side has to be on the other.
Yeah.
And you got an asset where, you got a phantom asset pretty much like you said, floating around.
Yeah.
Two people claiming it.
Yep.
But,
Yeah, and I think, and I,
has to recognize sale or rent or
Right.
revenue. The other one has to recognize the asset.
and I think the original intent of the standards that you're looking at now were designed to minimize this problem, but like anything else, when standards have bright lines, financial analysts and managers could determine or figure out ways to get around the rules, those loopholes. If it didn't bother you, right, which is A, why not?
I don't think we, as far as that flexibility.
All right, I mean, flexibility and, yeah, I mean, I think like any other accounting standard, you do have flexibility, like choosing LIFO and FIFO and all that, but anybody else? Yeah.
From a financial statement for the lessee, separate from the lessor, still properly reflects the assets or revenue or expenses for individual company. I don't think I'm having lessee recognized as an opportunity as lessor
Yeah, I mean, I think,
we've seen a lot of
mhm.
stock
Yeah, I'm just going to go, let me go to one of the things you said. I think, I mean, based on this example I gave you, I think the accounting does reflect, I mean, staying within the guidelines of the rules. Does the lessor have a guaranteed residual? Yes. Doesn't mean that the lessee has to guarantee it. So it does reflect the economics of that individual company's business, you know. And I think one of the things that a lot of people worry about from a finance or a financial analyst perspective is whether or not this information is misleading in any way. Now, it could be misleading in from the standpoint of like not having the asset on the books for the lessee. But I think in terms of industry comparisons, the industries are separate. So the financial service industry is going to be followed by analysts, and investment bankers would be doing work on financial service companies totally independent from the companies that are leasing this equipment. So from that standpoint, it's not, I don't think there's an answer here, but I just wanted to have you think about it a little bit, because this does exist in practice, and it's something that, I think will, if everything gets capitalized, this will go away, but I'm sure something else will crop up, because when we start looking at the new standard, it is becoming, and this always happens, when the IFRS and US standard setters get together, the first pass at it is great. It's nice and clean, and then all of a sudden, we start worrying, thinking about litigation, thinking about politics, about companies getting involved, and it becomes more and more convoluted and starts to look as bad, if not worse, than the original standard. So that's what's happening now. It's getting to the point where we're getting, you got a Type A lease, a Type B lease now, and it's crazy. Yep.
You look at people who are going to look at the financial statements, someone who could lease equipment, like an airline, versus the lessor who would be like a financial service company. You said they'll be looked at separately.
Right.
Knowing it's not like it's all the airlines would like to look at it as an operating lease.
Right.
All the financial service companies look at it as capital lease. So it's not like within the industry that they're putting.
Yeah, that's right. Mhm.
Looking at the financial statements in a way that you would be cognizant that this is, although it's an operating lease,
Mhm.
the reality is the industry operates in this way, whereas on the financial services
Mhm.
assets, it's not industry, how the financial service operates.
Exactly. Now, that's an excellent point, because when you're trying to value a company, so if you were doing a valuation, that valuation looks at your company relative to others in the industry. And if it's consistently bad, bad accounting, well, we know about it, and then we could offset it. So, for example, in here, if I was doing, heavy manufacturing companies that lease their equipment, airlines, as you said also, and if most airlines have off-balance sheet, they're all going to have it, and we know how to deal with it. We know how to deal with it, yeah. So now, that's not an excuse for not being transparent. I mean, I always said, when I teach this in financial service companies, I always tell the analysts, look, you simply go into the footnotes and you guys could figure it out. I mean, we're giving you the information. It's just not slapping you in the face. You got to really scrub the statements. I mean, now it'll be a lot easier if everyone uses the same method, but it may not be as reflective of companies' choices as well, right? Yeah, that's right. Yeah.
This is fine. That would just come up on the fact that said the analyst being astute on that industry.
Right.
Versus you got some that are concentrating on like airlines or heavy machinery, and you got others concentrating on finance.
That's right. That's right. Exactly. Yeah, and that's the argument because, industries would be separate and analyzed separately, and they have the unique characteristics, and usually the industry captures a similar style of accounting. Nobody in the industry wants to be that different, to stand out. Either one, if it's good, yeah, but they don't want to stand out and look that much different. All right, so that is the state of affairs, and we'll see what happens as we move along. All right, now, unfortunately, a lot of this maybe more interesting conversation has to be halted as we now look at the details of the mechanics. So what we're going to do is try to use lots of examples to apply the capitalization theory and the criteria, circling back. I'm going to constantly circle back and try to give you a review of the standard and the criteria as well, and the theory, of course. So let's take a look at this first illustration. I'm going to build off this illustration with some changes. So it tells you that on this is on page 4 of Module 2. We've got a company, Harrison Inc., on January 1 of 2013, leasing a multifunction copier directly from the manufacturer, Exact Image Company. So there are 4 payments, so the lease is a 4-year lease. The term is 4 years. The payments are $200,000. At the beginning of each year, the useful life of the asset is 6 years, and the selling price, if Harrison, the lessee, wanted to buy the asset, today's selling price or fair value is $158, and the interest rate is 10%. Now, the interest rate is the rate that would have been incurred on debt, so this is the incremental borrowing rate. And I'm going to assume it's equal to the implicit rate. Okay. Now, there's no residual value also. Residual value is 0. And I want to know what type of lease this is. So I didn't say anything about the revenue recognition conditions. By the way, if nothing is said about the revenue recognition conditions on a homework problem or on an exam, you assume that they're met. I'll only tell you when they're not met, or I may add that, but if there's nothing there, you don't have to worry about it. And also, if in the narrative there's nothing on the transfer of ownership or bargain purchase option, you assume it's not there. So in applying the lease conditions to this problem, there are no transfer of ownership, No bargain purchase option. Then we have to test the 75% and the 90% tests. If the lease term, and remember, what would you have to think about there? We have no bargain renewals. And that, by the way, is the way I'm going to go back and keep reminding you to look for these things. There's no bargain renewal there. So that, by the way, if there was a bargain renewal, what would happen? What if I said the company could renew this for 1 year at $50? Well, yeah, you'd have to add 5. Yeah, well, 1 more year would make it 5. I still, yeah. Right. Now, if it's IFRS, it's a capital lease. Under IFRS, bargain renewals could lead you under IFRS to believe it's a capital. Here, you'd have to test it. You'd have to make sure you test. So, for example, if the bargain renewal was for 2 years, then yeah, bargain renewal. Yeah. So bargain renewal, if it was for 1 more year, this becomes a 5-year lease. If it's for 2 more years, it becomes a 2-year lease, a 6-year lease rather. 6-year. Okay. So you fail the 75% test and the 90% test. Present value of the minimum lease payments are only 73%. And you could do that by using the tables. If you wanted to, you can use the tables. It's the present value of an annuity due for 4 periods at 10%, or use the financial calculator. And the present value of the minimum lease payments are only $697, $370. Let me just scroll back here, and that's only 90%. I'm sorry, only 73% of the fair value of the asset, so you don't pass the 90% test. So under US GAAP, this is a operating lease for both the lessor and the lessee. For IFRS, what do you think? It's probably a capital lease. Yeah. If it's a bargain renewal option, and that bargain renewal is for another year or 2 years or whatever it is, you'd have to add that to the lease term. And for the 75% test. I'm sorry? Yeah, you would add, if it was like $50 or something, you would add those in going out. Yeah, that would also, you would have to retest all the way through. Yep. So the lease term would be longer by the renewal period, and those lease payments would be added to the stream of payments. All right. So in this case, it is an operating lease, and we would make the entries. And as I said, some textbooks say that it should be prepaid rent because you're paying it at the beginning of the year. So on the next page, for the lessee, you debit rent expense, credit cash. And for the lessor, you would have cash debit and rent revenue credit. Again, you could also use the unearned revenue and then amortize it at the end of the year. Now, if the lessor has the asset on its books and it's not regular inventory, you would depreciate it. And by the way, most textbooks do this only to show you that the lessor still has the asset on their books. I mean, for me, I would not necessarily put this here if you're buying it directly or leasing it directly from a manufacturer who has the asset in inventory. But again, that's to show that you've got the asset on your books. And then finally, just some other possibilities, and I'll take some questions. Sometimes a lease requires, especially a real estate lease, requires an upfront down payment. And I think we talked about this in Chapter 5 or last semester, Chapter 12, in terms of the intangibles. If it requires an upfront payment, it's a leasehold. that is an intangible asset that gets, or a prepaid asset I should say, that gets amortized against the rental for the period of the lease. So these are advance payments or unearned revenue for the lessor, and they're prepaid expenses for the lessee, and they get amortized over the lease term. So you would treat the advance payment as a prepaid rent for the lessee and expense it, or unearned rent for the lessor. Leasehold improvements you should be aware of. They are permanent improvements to the lessor's property, so that audible, if they're leasing the floors upstairs, whatever they do to the floors, whatever they do to change the building, and the same with this, I mean, whatever we do to make this into a university setting reverts back to the owner of the building, and this is an intangible asset that gets amortized over the shorter of the lease term or the asset life. For the lessor, they wait until the lease is over, and then they assess whether or not there is value or cost to that renovation, because now what we've done to this building, the next person that buys this, if it's not a university, they're going to have some work to do. So we may be responsible for removing this or just leave it, and the lessor would have to be responsible. It depends on the contract. Okay, so any questions on the operating lease in this case? Now, let's go to a capital lease. And we're still going to have no residual values here. But the key point is right up here that says when you don't have a residual value, you have to recover all of your investment through lease payments. And that's going to be an important point when we go through the calculations. So it's the same company, everything's the same, except now the lease term goes to 6 years. Okay, so everything's the same except that the lease term goes to 6 years. Now, this is not always going to be the case, and I know, one of the things we always worry about, how are you going to ask this on a test? How am I going to see this in practice? And in this case, I just want to show you, and you might have to do this, but just to show you how the lease payments are calculated. In this case, the normal selling price of the asset is $958,158. I need to determine how much the payments should be in order to recover my cost as well as giving me a 10% rate of return. And if I took the factor for the present value of an annuity in advance for 6 years at 10% and divided that into the fair value or the selling price, I would get back lease payments of $200. Now we already know that. And by the way, just another issue that you have to keep in mind, this excludes, or I should say, there are no executory costs in these problems. So we have no executory costs. Or I could do this on a financial calculator where I calculate the payment. N is 6, I is 10. There's no residual value, so the future value is 0. The PV minus 958,158, and my payments are 200. So I know that the payment that I have to charge to recover my investment plus with the 10% rate of return is going to be 200. Now, once we get the payment and we have the other terms of the agreement, we can determine the type of lease. So in this case, if you go to page 7, again, there's no transfer of ownership, no bargain purchase option. So now that the lease is 6 years, we know that's 100% of the fair value, and that's going to be a capital lease. I also would probably ask you to test all 4 conditions just to make sure you know how to do them. So if this was an exam, you'd have to also show me that the 90% test is met as well. And if I took the present, we know what the present value is going to be, it's just working backwards, but the present value of the minimum lease payments is 100% of the fair value of the asset. You can either use the tables or the financial calculator. So because one of the four of the criteria are met, and once again we always assume that the group 2 conditions are met for the lessor, it's a capital lease for the lessee, and for the lessor it's a capital lease as well. Now, because there is no deal of profit, so they're getting this, if you go back to the problem itself, they're leasing this from a financial service company, and the financial service company paid fair value for the asset. So this becomes a direct finance lease. There's no deal of profit. They paid their cost was $958. So in this case, so if we just put the numbers in just to show you the logic, I guess, the selling price of the asset, $958,158, the cost, $958,158, well, there's no profit. There's no dealer or manufacturer profit, so it has to be a direct finance lease. It's got to be a direct finance lease. Now, with a direct finance lease, the only return to the lessor is going to be interest revenue. The only return to the lessor will be interest revenue. All right, and of course, when the lessee gets this, just to show you, I mean, I think you know what's going to happen, the lessee capitalizes it as the present value of the minimum lease payments down on page 7, and that, of course, is $958,158. And of course, we know that the lease is capitalized at the present value of the minimum lease payments, or fair value, whichever is lower. The interest rate has to be the lower of the two. We went through those two questions earlier. Now, there's just one last problem here, and that is when the lessee gets the asset, how do they depreciate it? And just one more little nuance, and then we'll go to an amortization table. This is the theory about the asset ceiling, fair value, and using the lower of the interest rate. That's just a summary for you. But here's the question. How do we depreciate the asset? And that's going to depend on, for the lessee, it depends on the criteria. And again, it should be very logical. I think it would be logical on page 9. If you capitalize using transfer of ownership and bargain purchase option, you're going to own the asset, correct? And if you're going to own the asset, I'm going to give you title, or you can buy it at a bargain. I know you're going to take it. Then you can use any useful life you want and any method you want. So if you're the lessee and you're going to get title either through a transfer of ownership or a bargain purchase option, you can use whatever method you want and whatever life you want. So if, the useful life is 6 years, but because of your maintenance policy and the way you use the asset, maybe the asset will last you 10 years. Take someone who could keep a car for 10 years. They may drive 3,000 miles a year, but they can keep the car for 10 years, where others using normal driving may have a car that's obsolete after 6. So if your usage, if your maintenance indicates that your asset will last 10 and not 6, then you could depreciate it using your own useful life and your own method. You're going to own it because of the transfer of ownership and bargain purchase option. However, as in this case, if you capitalize under 75% and 90% test, there's no guarantee you're going to own the asset. You might buy it. I mean, you could buy it when it comes off lease at fair value. But there's no indication on the day you sign the lease that you're going to buy it. You have to use the useful life, which is equal to the lease term. So you have to use the lease term and probably straight line. So when you read these problems, just be careful, because if it's capitalized in the transfer of ownership and bargain purchase option, it is a choice to use any method or any life you want. If it's 90% or 75% test, you have to use the lease term and probably straight line. And I think it's logical because, again, you're going to have ownership in the first bullet but not in the second. Now, that's one problem. The other problem I think we have when we start looking at leasing is the amortization table. And what I want to do is outline how you would build an amortization table using an annuity, and I started mentioning this already, an annuity in advance or an annuity due. Okay. All right, so let's look at the table and let me map out what happens. There are no executory costs. We'll get to a problem with that next week. Here's the real issue. The biggest problem or the confusion when people see this for the first time, and I was explaining it a little earlier today, is that the payments come off up front. So when you look at this on January 1 of 2013, as soon as you lease the equipment, you make the first payment. The payment comes off, and then interest is calculated. So interest is accrued for the year, and it is based on the balance after deducting the payment. And that's what you see here. Payment comes off, that's the amount subject to interest. That's the interest for that particular period. Now, moving ahead, and by the way, if you wanted to, and again, it's up to you, if you remember, on December 31st, on our balance sheet, we broke up between the interest payable and the current portion. Well, that's the way it would look. Because your next payment, when that next payment comes in on January 1, on January 1 of the next period, the payment comes off first, and once again, 10% interest, interest accrues at the end of the year. So when you build this table, you have to be sure to understand that the interest comes off first. The payment comes off first, and then the interest is computed. And then if you want, I mean, I can just take it down to this number if you wish. And then going forward, it would be, I'll just put it right here. Well, you could see it, but it would have been 633, 976. I guess I could do it there. And that's going to be 697, 373. And then the payment comes off that on January 1. Yeah, that's what we're getting now. Yeah. I kind of ran out of space, but that's going forward here. If you continue the line. Yeah, interest. Yeah, interest on December 31st, payment on January 1st. So, again, one of those things that you got to keep looking at, practice it a little bit, and it'll flow pretty well. The other issue here is the fact of a little terminology. You sometimes call the sum of the lease payments the gross investment in the lease. A lot of people, a lot of textbooks do this where they set up the receivable at the gross amount. You got the deferred interest here as your discount, and this is the net investment. Now, we're going to use a net investment approach. We're not going to use a gross investment approach, but that's just some of the terminology. And notice, of course, that at the end of the lease, there's no balance. So your last lease payment, totally liquidates the receivable and the liability, and that's because there's no residual value. So at the very bottom of the table, you'll see a 0 residual value, or no balance. Now, when you look at the table, just make sure you can build it. I'm going to show you some journal entries. And then we'll pick it up. Just want to show you 1 or 2 entries now, and I'll pick it up with you on Tuesday. Let me just put these up on the screen's probably better right now since I got all that writing on there. Okay. All right, if you go to page 10, I'm just going to leave this up on the screen. If you go to page 10 and look up at the monitor, for the lessor, when they sign the lease contract, they debit the receivable, so they're putting a liquid receivable on their books for the present value of the minimum lease payments or the fair value, whichever is lower, and they credit the equipment inventory or regular inventory. Now, that replaces the asset, the plant asset, or the inventory with the liquid receivable. They also get the first payment up front. The first payment has no interest. That's extremely important to understand that if you look at the journal entries as well as the table, that there are no interest components in that first payment. Then the interest accrues so that at December 31st, you'd have to, as I'm showing you here, even on the timeline, that the interest accrues and you debit the interest receivable and credit interest revenue. And that's on the lessor side. If you move to the lessee side, then just one additional entry. Obviously at inception, you debit the lease equipment, you credit the lease liability. The first payment just pays off the liability, principal only, right? Comes right off the principal amount. If you look at this column, there's no interest. and then, of course, the accrued. You have to accrue interest at December 31st by debiting interest expense, crediting the interest payable, and then we depreciate the asset. Now, the way we depreciate this asset, again in this case, is using the straight line method over the lease term. Why? It was capitalized using 75% and 90%. There were no transfer of ownership, no bargain purchase option. And of course, you're simply going to debit the depreciation expense and credit the accumulated. Now, all of the other payments will be the same, except that from now on in, if you look at the first payment here on 2014, every other payment except for the first has to split principal and interest, right? So when you collect 200, you're going to have a debit to cash for 200, a credit to the liability for 124, 184, and a credit to the interest receivable